Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at Crocs this morning, stock is up 18% pre-market after their Q4 earnings release, and I'll take a look at those in a second. Do note, I bought some shares of Crocs just the other day prior to earnings. It was a very small position. I was actually hoping that the earnings wouldn't be explosive, that I could have more time to accumulate a position in the 80s, but unfortunately, the stock is into the 100s after this earnings release. However, it's only back to where it was in February of 2024. This has been an up and down roller coaster for the last couple of years. This is a brand that really exploded post-pandemic. They went from a $1 billion revenue business to a $4 billion revenue business within the span of these 5 years. A lot of that was the Crocs brand itself and natural growth there. They did acquire a brand called Hey Dude around 2021. They overpaid for that, $2.5 billion for a brand that's currently shrinking. They've been paying down that debt, but they are still a very cash flow generative business. They use that to pay down that debt, but also to buy back a bunch of shares, and that has really been the story here. Whenever it gets into that 15% free cash flow yield, and it has been in that range a couple of times in the last couple of years, that's when you really start getting the value of those buybacks, and that's when I've been a buyer and will continue to be a buyer as long as the stock keeps doing what it's doing. This is a company that has a tendency to underpromise and overdeliver. You look at their Q4 guidance, basically flat revenue growth. What they actually achieved is 3.5% revenue growth, better revenue growth for Q4, obviously better revenue growth for 2024 as well. And that's a good sign for things to come. A couple of other things that stand out here. Crocs, still the crown jewel of their two-brand empire here, up 8.8% for the year, 4% in Q4. You can see a bit of a deceleration there. That is a bit of a concern for investors. One thing to keep in mind, that this is not going to be a growth story anytime soon. They're certainly trying to accelerate growth in Hey Dude and Crocs as well, but it's not really showing up in the results. There's certainly a maturity aspect that comes with their Crocs brand. North American revenues are flat for Q4. International revenue is still growing, still a lot of potential for market expansion there, but I don't think growth is going to be the story here anytime soon. Hey Dude, similar thing. Yes, expectations were for that to shrink -5%, and it's actually flat, which is good news. But as we look at the 2025 guidance, they're still expecting that to shrink in 2025. So obviously not back to growth anytime soon. And that's really been a negative story for the stock for the last 2 years or so, because that's been a downer on their top line and also putting a bit of pressure on their margins. But it's really the margins that are still the story here. Operating margins of 25% for 24, that's down from 26% the year before. Some investments in both of these brands were being made that are not going to be a long-term thing, but eventually will hopefully pay off in terms of top-line growth. But when you talk about 25% operating margins, compare that to other shoe brands, it's best in breed. Maybe Birkenstock is there, Deckers is maybe in the low 20s, but other shoe brands are in the low to mid-teens at best. So what this allows them to do, even without growth, they're still generating a ton of free cash flow. That free cash flow recently has gone towards paying down debt from that ill-fated Hey Dude acquisition, but also buying back shares. They bought back $500 million worth of shares. Unfortunately, it was on an average share price of $127, so not a good sign for investors there. But now that the price is more depressed, they're probably buying at a much better free cash flow yield, and that can mean really good long-term returns, especially if they can ever get back to growth. However, even if they don't, even if growth remains pressured, even if it's slightly negative, they can still be a good compounder just on the basis of buying back shares and improving that bottom line with a lower share count. So when you look at their balance sheet here, they've gone from $2.1 billion in debt down to $1.3 billion in debt in 2024. Probably continue to pay that down a bit, but the focus now is going to shift towards share repurchases. They have $300 million left, adding another billion to that, going to focus on reducing that share count, and that's going to be a good thing for investors going forward. And that's really why I'm interested in the stock. This is very much a share repurchase story. It doesn't have to grow the top line very much to grow their bottom line quite a decent amount due to the lower share counts that are going to come from buying back shares at a free cash flow yield that's now in the low teens. That's a pretty good use of company funds. I'm glad that they're going to focus more on share repurchases now versus focusing on paying down that debt further, because the shares are very attractively priced now, and they should be buying back as many as they can, as quickly as they can, before the market realizes that this is a very interesting value at today's price point. As we look at guidance for 2025, not amazing, down 3.5% for Q1 2025. A lot of that driven by Hey Dude shrinking by 14 to 16%. Again, that brand sucks. That's kind of the takeaway here. I don't know when they're going to turn it around. If they ever turn it around, this is going to be a huge, momentous occasion for Crocs shareholders. But right now, this thing sucks. Crocs brand down about 1%. However, for full year 2025, they're expecting revenue growth of 2 to 2.5%, which is more in line with what the market was expecting for 2025. Crocs brand growing at 4.5%, and then Hey Dude shrinking by about 7 to 9%. So overall, guidance not too amazing, but it's in line with what the market expected. So I don't think the reaction is going to be hugely negative. So the Crocs thesis, again, very much a share repurchase, debt buy down play. Don't need a ton of growth, but growth would obviously be a positive here. And you can see that growth potential might still be there. You've got Crocs. It's a $4.1 billion business. And you've got this total addressable footwear market that's nearing $400 billion worldwide. Now, this is obviously an optimistic slide, but you can kind of see that there's opportunity here for a company like Crocs that's being priced for next to no growth. And that opportunity probably exists in this 160 billion pie right here. You've got clogs, which Crocs is the leader in already, so maybe there's not a lot of room for expansion there. But then you've got sandals in there. That's a $35 billion a year business. And Crocs is only starting to move into that area of the business. That's only about 10 to 15% of the Crocs brand are sandals. Then you've got the casual total addressable market. That's really what they were targeting with the Hey Dude acquisition. Not sure that's working out very well, but you can see that there's some opportunity here. I'm not saying that this is going to be this massive growth stock that suddenly is going to be an $8 billion business, but even if this becomes a $5 billion business within the next 4 to 5 to 6 years, that would be a massive win for a company like Crocs, because right now expectations are basically in the gutter for this company in terms of their growth opportunity on a go-forward basis. And I think a lot of that opportunity comes from those international markets, not just from Crocs, but also from Hey Dude as well. You've got UK, US, and South Korea. These are markets where you've got decent market share. You're talking about 2 to 3% market share in these three mature markets, and that's kind of why their North American growth in Crocs is close to zero or low single digits at best. But then you've got these other markets. You've got China, France, Japan, Germany, and those markets are either sub 1% market share of all shoe sales there or 1 to 2%. And you can kind of see that by increasing awareness, by getting their shoes out in front of those people, there's a lot of opportunity there to drive more market share in some of these markets and actually grow the international revenue, which is going to put some pressure on their top line due to currency impacts. But end of day, it's going to be a positive if that were to happen and international becomes a bigger piece of their overall pie. When you look at their overall values that they offer, there's talk about, hey, the consumer is being pressured. They're having a tougher time buying certain things. That's why stocks like Nike are struggling. Obviously people aren't able to afford $150 to $250 shoes, but that's not really where Crocs is. Crocs has a very good value proposition. You can get shoes for $30 from Crocs, and they still make a pretty good margin from them. The only issue and the only risk with this, as I think about it as a Crocs investor, is what do tariffs do to their business? They make a lot of their products in China. Will that mean they have to raise prices? Will that mean they see pressure on their margins? Because that is certainly a concern that I have as an investor as I look into their guidance for Q1 and 2025, because there's obviously some pressure on the bottom line that they're assuming over here. Operating margins are being pressured versus what we saw in 2024, going even lower than 2024 in 2025. Top line growth is still there, 2 to 2.5%, but you're seeing some bottom line pressure. You're seeing some EPS pressure that's leading to basically flat year over year EPS on the top end. And that seems to me like they're assuming that there's going to be some tariff impact. They're assuming there's going to be some pressure on their bottom line, and that is going to flow through to some of these EPS numbers. However, these are still good results. When you look at a stock that's trading at $100 pre-market, who knows what it's going to open at, versus a $13 forward EPS, you're looking at a forward P ratio in the mid to high single digits, depending on where the price is any given day. That's certainly not too bad when you consider where the rest of the market is trading at. And you've got a company that's buying back a ton of shares at that price point, and that is going to mean that if and when growth returns to the top end and or the bottom end, that coiled spring might really explode and provide some solid returns to investors. So expectations here aren't going to be through the roof. For 25, analysts are 2.2% right in line with their guidance, maybe slightly higher for 26, 27, and 28, although 27 and 28 don't have a lot of analysts predicting stuff yet. Free cash flow, still very solid, but you can see in 23 and 24, their free cash flow numbers and their margins have been very solid. They're doing a good job of converting their operating income into free cash flow. Disclaimer, as we look at the valuation here, this video is purely for informational, educational, and entertainment purposes only, is not investment advice. I'm making this video pre-market, so I popped in a 105 price here just to have a reasonable evaluation of what their market cap might look like this morning. $6.1 billion market cap, $7.7 billion enterprise value, still paying down some of that debt. That's a 13.3% free cash flow yield, or a 15% free cash flow yield based on 24 actuals, 13% based on 23 actuals. If they're going to buy back $1 billion plus worth of shares at that free cash flow yield, that's a pretty sizable reduction in share count if the stock price remains where it is. When we look at the revenue growth, we've got actuals for 24. Then I've got 2% growth for the next couple of years. Margins on the free cash flow side, they're much lower than actuals for 23 and 24. I want to account for any uncertainty around tariffs, currency impact, all of that stuff that may come into play, because I think this tariff thing could be a long-term thing that may impact the stock price quite a bit and may impact their margins. Not sure if tariffs are raised in China, will they be able to pass through all of that to consumers, or will they have to eat that in the form of a margin impact? I think it'll be more the latter than the former. A lot of this free cash flow going towards stock buybacks. I've got 60% of that going towards buybacks, net buyback of about $2.2 billion within the next 4 to 5 years versus a $6 billion market cap. That's significant reduction in share count. If you want to play around with these numbers, hit file, make a copy. There will be a link to this file down below. That still leaves them with $1.6 billion in excess free cash flow for debt paydowns and acquisition, more buybacks, whatever they want to do. What's the right fair value for something like this? I have 50% at 8%, 50% at 9%. You can play around with these numbers as well. You can just change the fair free cash flow yield to whatever you want here. The calculations carry on through. So that's an 8.5% free cash flow yield as a more mature business. I feel like if they show their staying power, they really prove out that they're not a fad. I think the market's still worried about that. Show that they can maintain margins through periods of tariffs. That's very fair. And even in March of 2024, this was trading at an 8% free cash flow yield. So the market does sometime get a bit more optimistic about this company, and that could happen sooner than later. And if that does happen, you've got an expected return of about 15.3% at a 105 price point, closer to 19% when it was trading at $88. So at $88, this is definitely a buy. At 105, it still seems like a very fair value. I've got a fair value of 106 if I'm targeting a 15% return. The nice thing about this is a lot of the return comes from buyback yield. You don't have to have a ton of growth, don't have to have a lot of margin expansion, although both are nice because you're getting back shares at a very affordable price point. They're buying back shares rather at a very affordable price point, and that's going to mean a higher EPS down the line, even if revenue growth is low or even shrinking. So that's why the buyback yield here makes up a good part of the return, even if the free cash flow yield remains in that like 13% range and the market doesn't reevaluate this, because a lot of this return is coming from multiple expansion. Right now, the multiple is compressed. the assumption is that it will expand in the future to get to this return. But even if that doesn't happen, you're still potentially seeing a high single digit return just on the basis of buyback yields, even without a ton of top line and or bottom line growth. And if those are added, that can really explode this stock in terms of return, because you'll get top line expansion, bottom line expansion, and then your multiple will expand just like it is right now, because growth is happening and the market didn't expect it. Because right now the market obviously isn't pricing in a lot of growth, it isn't pricing in a lot of margin, still pricing in a bunch of risk to the brand and the idea that it might shrink in the future, that this is still sort of a fad. I don't think that's the case. Again, this isn't a huge position for me, so I'm not like super strong about that statement, but I do think that the valuation here is very, very interesting just on the basis of buybacks alone. And I think there's potential upside in growth from international markets, from, you know, an acquisition if they decide to make one, although obviously the last one didn't pan out at all. They would have to be more selective and get it at a much more attractive valuation, which shoe brands are certainly more attractively valued right now than they were in 2021. Because if they bought Hey Dude right now, it would probably be like a $500 million acquisition versus the $2.5 billion that they paid for it back then. So that's something to keep in mind. What do you think about Crocs? Am I wrong here? Is this a fad? I do think this is a brand that is very popular with young people, with young adults, even millennials. And I think as those people age up, they're still going to like that brand. They're not going to age out of it. And I think that's the beauty of something like this, that they're targeting people that are going to age with it and enjoy it as they get older as well. And then they're moving into adjacent spaces with Hey Dude, with the sandals that are coming out that are less weird and kitschy than their standard clogs, and are now allowing them to target a whole different demographic. And hopefully that will lead to some additional growth down the line. And as long as they can maintain their best-in-class margins, this should be a really interesting investment that I will probably continue to build out, especially anytime it's under $100. Because whenever Crocs is trading in the 80s, I'm in. Now that it's in the 100s, low 100s, I still like it. I might still slowly build out a position, but again, any news around tariffs, something like that, could send this moving in the negative direction. But that's just a short-term thing. But in the long term, I still like the trajectory of the stock with their share repurchase plan and all that stuff going on. So what do you think? Comment down below, like, subscribe, all that good stuff. And thanks for watching. Bye.